Hello, and welcome to this week's edition of Checks and Balances TV. Today's program is entitled, "The Federal Reserve Extends Historically Low Interest Rates. Is this good news or bad news for your finances?" So let's see how today's news may impact your financial future. The Federal Reserve announced on January 25th that consumers and businesses can expect the same historically low interest rates to continue through 2014. The federal funds rate, which is used to set interest rates on loans and savings, fell to a record low during the height of the financial crisis in late 2008. The Fed has stated it will not raise the federal funds rate until the economy improves and will begin providing interest rate forecasts as part of its quarterly reports moving forward. The Fed's first report of 2012 noted that economic conditions are not projected to change dramatically over the next 2.5 years, which is why the Federal Reserve is expected to keep the funds rate at its current low level. Okay, so what's really going on here? Let's check the facts using our checks and balances process. The Federal Open Market Committee resides within the Federal Reserve and makes key decisions about interest rates. This committee sets monetary policy and determines the federal funds rate, which is the overnight interest rate banks use when lending to each other. Banks typically add prime to their interest rate, and that's what they usually charge their most credit-worthy customers who want to borrow money from them. The committee cut the federal funds rate to an historically low range between 0% and 0.25% on December 16, 2008, in an effort to stimulate the U.S. economy. The committee has cut the federal funds rate a total of 10 times over a 15-month span between 2007 and 2008 in hopes of boosting consumer and business spending during and after the recession. The committee's decision to cut the federal funds rate in 2008 was designed to promote lending on a favorable basis to consumers. The intent of the cut was to encourage consumers to borrow money and subsequently spend more money. The committee felt that unemployment was too high at that time, while consumer spending, business investments, and industrial production had all declined, to a point where federal assistance was needed. After Standard & Poor's downgraded long-term U.S. debt from the top AAA credit rating to AA+ on August 5, 2011, the committee decided it was necessary to keep the federal funds rate at its current low level. However, the downgrade has caused even more concern for the future of our economy. So the committee announced the federal funds rate would not change until at least the middle of 2013. However, Fed Chairman Ben Bernanke said last week that the Federal Reserve's plan is to now hold these near record low interest rates until at least late 2014. Okay, so now that we've checked the facts, let's balance this news using our checks and balances process to determine what action you should take today. The Federal Reserve's job, if you call it that, is to predict unemployment rates, inflation, and economic growth in its quarterly reports, all of which have an impact on determining the federal funds interest rate. Adding a quarterly update on the federal funds rate to the mix may give Americans more transparency regarding the country's real economic conditions. The fact that the Fed is not changing the federal funds rate is a reflection of their dismal economic outlook, which projects continued slow growth. While unemployment numbers dropped to their lowest level in almost 3 years this January, the Fed does not believe that this trend will continue. The committee expects the unemployment rate to level off and average between 8.2% and 8.5% by the end of this year. After the most recent unemployment numbers were released, Fed Chairman Ben Bernanke warned that, quote, "We still have a long way to go before the labor market can be said to be operating normally." He's a pessimist. But the big question here is, has Bernanke's committee done the right thing by lowering the federal funds rate to historic lows and then keeping them there for an extended period of time? Bernanke took office in his current position on February 1, 2006, and has led the charge for all 10 of the rate cuts. Critics blame him and the other members of the Fed's Board of Governors for contributing to our slow economic recovery. And by the way, these 7 members of the board are some of the most influential people in America and control our interest rates, which impact all Americans in some way. Yet none of them were voted into their positions of power by you or myself. Instead, they were nominated by the President and confirmed by the U.S. Senate. The real problem with the Fed's decision to keep rates low, though, is that it is truly hurting Americans who are either saving for retirement or who are living off of their savings in retirement. With record low interest rates, safe money options such as certificates of deposit and Treasury bills, bonds, and notes are all paying, unfortunately, pitifully low returns. Okay, so what's the bottom line here? The Fed's goal in cutting the federal funds rate was to promote spending, not saving, which is bad news for many Americans who are either putting money away for retirement or living off their savings in retirement. Of course, there are two ways for Americans to look at these low interest rates today. On the one hand, businesses who are borrowing money at such low rates could, in theory, hire more employees and hopefully grow their revenues, which would increase their stock price. On the other hand, the Fed has essentially acknowledged that the economy is too weak to survive a rate hike at this time. So investors may become hesitant to buy stocks and invest more money in American businesses. The Fed's low confidence in the U.S. economy for the next 2.5 years should be viewed more as a warning sign than anything else. And retirees who are looking for a quick economic turnaround will likely continue to be disappointed with extended low yields on interest-linked financial products. The unemployment rate falling for 5 straight months looks like a step in the right direction. But if it was really positive news, the Fed would have raised the federal funds rate and rewarded savers and retirees. And now for Matt's weekly financial tip, tool, or technique. Based on the Fed's current economic outlook, the short-term future does not look bright for savers who are putting money away in safe financial vehicles. And retirees in particular are struggling to find reliable income sources to help them live comfortably during their golden years. So here are 4 ways that retirees can earn a dependable income during retirement. Strategy number 1 is stock dividends. One of the Fed's goals with keeping interest rates low was to spur investing. However, with investing comes risk. So be sure to only invest what you're comfortable losing potentially. And carefully selected companies who have a long track record of paying good dividends each year could be a viable option as an income source for you in retirement. Number 2 is fixed annuities. Many fixed annuities can provide you with a guaranteed source of income, no matter how long you live, giving you a form of longevity insurance to carry you all the way through your retirement years. Number 3 is CDs and treasuries. Low interest rates are certainly not helping yields on CDs, but they can provide you with reliable interest income each month. Like CDs, Treasury bonds are also yielding near record low rates of return, although they are still one of the safest places to put your money in today. And number 4 is pensions and Social Security. Some retirees don't have much to fall back on for income besides a company pension if they're lucky, or Social Security. If that's the case, consider your payout options very carefully before you trigger them, so you can receive the highest monthly income for both you and your spouse. A well-balanced retirement income plan includes a variety of income sources. Diversity and proper planning can help you to stretch your savings to last the duration of your retirement. Contact a true financial advisor for any assistance you may need with developing an income plan that you cannot outlive in retirement. Be sure to log on to our website and download our featured report, The Truth About Bonds, a free report that reveals the pros and cons, both sides of the coin, on this important financial product so you'll know if it's the right investment for you. And finally, remember that only you can control your financial future. You can succeed. You just need confidence and determination. I'm Matthew J. Reddick from Checks and Balances TV. Until next week, dump debt, invest wisely, believe in yourself, and make it happen.